Hi, everyone. Welcome, good afternoon, and welcome to this panel about, as Anna mentioned, voluntary carbon markets and the role they have for the energy transition. I'm very happy to be joined by Gordon Bennett, Managing Director of the Utility Markets of the Intercontinental Exchange, or ICE, as we know it in the industry, by Tommy Ricketts, Co-founder and Chief Executive of B0 Carbon, and by Noah Deitch, Deputy Assistant Secretary of Office of the Department of Energy from the United States. So we are going to discuss the role that voluntary carbon markets have to achieve the energy transition, to achieve the net zero emissions by 2050. So I will start straight away with the panelists, and I would like to ask Tommy, what are the voluntary carbon markets, and what are the role do they have for achieving the energy transition?
Thanks, and thanks for having me. So I start maybe with the second part. So what is the net zero transition? Because I think it contextualizes the voluntary carbon market. It's essentially a giant balance sheet exercise. On the liability side, globally, we have to understand where all our emissions come from, what the sources of those emissions are. We have to try to calculate them as accurately as possible, both today and on an ongoing basis, and then try to say, how can we address them? Now, the simplest solution would just you price them adequately and you crack on with it. But absent a global government, you have to think, okay, what is the decarbonization strategy? How do I reduce and I substitute my activities on an ongoing basis so that every unit of output has a lower unit of CO2 emissions? The problem is, both today and on an ongoing basis, you need to get there, and in getting there, there is this residual. Now, the residual today is about 98%, and according to the IPCC numbers, on a steady state by 2050 would be about 30%, i.e., what part of the solution can be brought about by the carrying capacity of the planet and the solutions to compensate for those emissions, and what can you actively decarbonize? And this residual is where the voluntary carbon market is trying to play. So the voluntary carbon market is very simply an area where people can come in and buy these things called carbon credits, which are supposed to represent a ton of avoided or removed carbon, and ultimately use it to offset, if you will, those emissions which they can't readily reduce either today or on an ongoing basis. Now, the role of the voluntary carbon market, if these carbon credits actually deliver what they say they would deliver, would be, in my view, to accelerate the net zero transition. The challenge is, do they actually do what they say? Now, there are two ways, and I'll kind of pause there, but there are two ways in which you need to think about that. First of all, do they have the credibility to actually implement that? You need the market mechanisms, which is where people like ICE and all the sort of institutional players from financial markets come in. The second stage to it is the information. How do you actually interrogate, fundamentally, by means science, policy, and financially, the underlying claims of these carbon credits? That's an information system, or what I'd call risk analysis. So if you can get the market mechanisms to be working, transparency, disclosure, systems of exchange, and the information to be delivering what they actually say, and I'll come on to talk about what we do as a ratings agency, then you could actually, in our view, get to a position where these credits could substantiate and support the compensation side of that net zero transition. And that's how they come together.
Perfect. That leads me to another question for you, Noah. What work is the Department of Energy doing to accelerate the adoption of, or in relation to the VCM, to the voluntary carbon?
Yeah, thank you. And it's great to be here. I think where we play a role from the US government perspective is not a regulator or any sort of intermediary in a market, but rather a source of innovation. What we want to do is make those really high integrity carbon credits widely available, low cost, and to really drive the bar about what it means to be high integrity. Right now, there's a wide range of carbon credits that are being purchased in terms of not just their price, but all of the different attributes around permanence, additionality, all of these key variables that actually matter to the climate, which is why we're doing this. And so we really want to see a race to the top in terms of the integrity of those credits. And I think doing both of those things actually has an interesting side effect of the voluntary carbon market can actually help reduce the need for a carbon market in the long run. We should be trying to drive innovation so that we are making clean alternatives just business as usual. And the more that we can do that, the less we're going to need to rely on instruments to kind of offset those residuals that you mentioned.
Perfect. But there is this discussion that there is this need to drop the B of voluntary from the voluntary carbon market. So I want to ask Gordon, like, why do we need to drop the voluntary aspect of the carbon credits?
Well, I think to sort of promote the uptake of it, calling something voluntary is maybe not the way to sort of batch it up. But I think importantly, there's a knowledge gap between the science, economics, and markets. And it's not a theoretical knowledge gap because actually they're all linked, and environmental markets is what links them together. You know, in economics, we talk about valuing externalities, and there are markets today on ICE and other places that value externalities, and we know the science. So it's not a theoretical gap; it's a knowledge gap, and having an argument about where things go in buckets is sort of the wrong argument for me. There's too much time being spent on bucketing things that don't really you end up in an argument of whether something's voluntary or compliance. I think the focus should be on what the underlying instruments do, and essentially these are all economic tools to promote positive environmental outcomes. And I think more time should be spent narrowing the gap between the science, the economics, and the markets, rather than sticking in buckets or try to get a label on something.
Perfect. And we may agree, but that voluntary carbon markets are expected to grow exponentially during the next years, especially in a context where many governments now are putting a lot of interest on energy security at the expense of energy transition. So that leaves the private sector to be more aggressive on that. So carbon markets will grow exponentially. So Tommy, I wanted to ask you, like, which are the challenges for the carbon markets to absorb the growth and to grow with not at the expense of quality?
So I think the voluntary carbon market, however you want to define it, the carbon markets have an opportunity to do two things. One, as I said, accelerate net zero transition. And to do that, you have to have integrity. I'll explain what I mean. But the second stage is, and this speaks maybe to your point, is it's actually a new financial asset class. And so what that is, unlike traditional asset classes, which have traditionally created revenues and profit out of extraction and depletion, you're actually trying to create profit out of regeneration and renewal. And so there's a very interesting lens there about why they should grow. And hopefully over time you see on the FT or the Wall Street Journal and the Economist, the price of carbon, the price of biodiversity, the price of water systems. So there's that whole point to why they need to grow. But the volume, the volume is, it may or may not happen. You know, we've had a stop and start, which was the CDM market, and maybe this will stop and start again, because you have to have integrity. And what I mean by that is you have to have levels of transparency, levels of disclosure, and a system of risk analysis which substantiates what this voluntary market credit or voluntary credit looks like. And just to give you one tiny flavor of that, you mentioned there's lots of heterogeneous types of projects. You have everything from fugitive emissions to direct air capture, mangrove systems to soil systems. There is no other asset class we've generated which is so varied. And the system we use to interrogate it came out of an NGO initiative, 20 years ago, which is effectively you issue a credit and it's 1 or 0. And the methodologies that you use to issue these credits, of which there's hundreds, vary wildly across the standard bodies. And so back to your point of how do you scale it, you have to allow, my view, I used to be an analyst at an investment bank doing multi-asset research. Capital asks questions. It wants to price that adequately, and that should ultimately lead to the growth and the expansion of this because the demand is there. But it can't assess these risks. And people talk about greenwashing, they talk about reputational concerns in the area. It's not really, it's just that you can't understand what the underlying risk dimensions of these assets are. Because it's never been, to your point, brought together like a financial market entity. It's still somewhere sitting between sustainability and the environmental pages. It's a frontline asset. So back to that point, I do believe it can grow, but to do that, you have to have a system of risk analysis to let it grow. And then also you need to make sure that if that happens, you actually get the type of, exponential growth that you could look for. So.
And I think the key about it being voluntary is that growth has really big benefits to climate if it is driving a high bar. If it is creating a really high price signal that's encouraging companies, countries, organizations that are looking to price carbon to directly reduce emissions, that's a great outcome. If it is encouraging more and more people to create a demand signal to drive down the costs of those really robust solutions, that's a great outcome. And so we have to think about, given these are not compliance markets, there's no mandate to do this. It's how can companies opt into something that's going to have a greater impact than it might show up on just that carbon math and that ledger. And these are two ways that we can get to that outcome.
So I would add that in terms of scaling them and whether these are going to grow or not, ultimately they're only going to grow if there's a demand signal and a robust demand signal. And for me, what that comes down to is companies treating their emissions footprint as liabilities. That creates the demand signal. And because at the moment it's an opt-in sort of process, then you don't have a strong demand signal. So if more companies who were committing to net zero were treating their emissions footprint as a liability and they compensated for them, then what they're compensating in them is a carbon allowance or a carbon credit. So that creates the demand. And if you think that we're at sort of 50 gigatons today and we need to go to like net zero, that's a lot of emissions liabilities, and so the price of these things should be very, very high because there's not enough supply of atmospheric reductions and removals to meet that demand. And the reason today why there's not more demand is because not enough people are treating them as liabilities.
Can I just add that one of the unique twists on that is, so you have the high innovation areas that require big investment, such as you were talking to me about the administration investing in. These are deflationary cost curves. So the more investment, the cheaper it gets. So how many investors like to invest in things that the price is going to be going down 200% 5 years from now? Obviously, you require government intervention to get that going. But on the other side, you've got countries, Gabon, Papua New Guinea, where the marginal cost of generating high quality, potentially nature-based solutions is genuinely $2 or $3. So this is where I meant the price signal doesn't mean it should be inexorably higher. Different types of solutions have different break-evens. And so in a marketplace, that would come to bear. You should be buying all the cheapest, and then the next cheapest, and the next cheapest that are delivering the outcomes that you want to be doing. And you move up the cost curve as the solution gets wiped out, or you fill the thing. That's where the market has a role to play, because that is a exchangeable. That's an interaction. Legislating for that is very complicated and would lead to very strange things, just as an aside. It's not inexorable price increases that you definitely want. It's getting the right prices for the right types of things.
Well, the fact that it's so complicated, net zero is not something that's simply solved for. It's exactly why you need markets and price signals, so you allow people to figure out where they're going to allocate capital. People have different views of where value is and how net zero will be solved for. If you can value positive and negative externalities, it allows you to reallocate capital to the stuff that's positive from an atmospheric point of view. And I think without the price signals, we're going to make net zero very difficult and somewhat abstract.
Yeah, but that's an important point, is that we do value different things when we think about net zero. And so we don't want to over-optimize on carbon and the atmospheric value. We can't just go out without any guardrails and say what we're going to do is find those cheapest tons and march up a supply curve just focusing on carbon. There are big impacts to social indicators, biodiversity, other environmental outputs. And so it's really important to have a broad systems view on this too, and not just kind of over-optimize on marginal costs.
Yeah, I agree. You need instruments. The ecosystem services isn't solely about carbon, but also there are tools that allow you. The New York Stock Exchange is developing natural asset companies that's valuing ecosystem services in an equity type instrument rather than a carbon credit, which you could argue is a bit more of a commodity like instrument. And to Tommy's point about heterogeneous versus homogeneous, nature's heterogeneous. So actually an equity type instrument could be a great solution for attributing value.
Perfect. I have seen many people nodding, and I would like to open the floor to questions. So if anyone has any questions to do to the panel, please. Is any microphone? No? Yeah, just speak out. Yeah.
Given we're in London and we're talking very much kind of from a European and American perspective, do you have any views on how you bring other parts of the world with you in order to drive carbon credits for them and for us?
Did you?
The question is, how do you bring the developed developing world alongside the developed world to make sure they get the most of it. So a very interesting example, don't quote me on this, but so there's about 7 carbon surplus countries. Only 7. I think 198 countries, so 191 are in carbon deficit. So effectively, there's only 7 that can now export what is effectively a national asset. And Article 6 basically nationalized carbon. We can explain that another time. So you have these 2 accounting regimes. You have to basically be net zero as a country, and you have to be net zero as a company, and you have to have 2 systems that basically understand that. So to your question, potentially, this is why I left my job to work in carbon, to hopefully do something in carbon markets. You have an enormous wealth transfer for an asset which the developing world is very rich in, which is regeneration and restoration of the natural environment, which would create a big wealth effect from the developing world where you have huge industrial and liabilities, to Gordon's point. If you value those liabilities, the assets naturally sit in the global south, or whatever to just define it. So that should be a big wealth effect. That's the hope, right, in terms of the system. And that would be very exciting if that could take place.
Yeah, I think that's a part of the answer for sure. It's not going to just happen naturally. I think there's a wide range of financial instruments that are going to be required, a wide range of investments beyond those specific market mechanisms to actually drive wealth creation and flows of money to those countries. And I think it's important to, again, think about a broader set of tools.
Yes. Please, there is a microphone coming. Yeah. If you want to introduce yourself, that would be great.
Thank you. My name is Godfrey. I work at TreeUp for a global tree planting organization. I'm very curious to know about what is the approach of the Department of Energy in the US towards the voluntary carbon markets. How are you hoping to get involved into that? Do you want to work more closely to project developers? Do you want to help in the monitoring? Because it's very often one of the biggest parts post that these projects have been certified. How are you hoping to get involved and help in this whole market?
So I think there's 2 key tools that the Department of Energy has to advance voluntary markets. I think we have very large grant programs. It's kind of a once-in-a-generation congressional moment in the United States where we've actually put money in the billions of dollars of scale on the table to support projects. And so supporting projects that can, in the future, generate carbon credits is exactly one way that we can play. There's also an enormous science and innovation apparatus at the Department of Energy. And I think that is going to be key for measurement, reporting, and verification across all of these different asset classes. And we already have developed some of those programs. But again, it's very bespoke. If you're talking, again, about a direct air capture machine, you might need life cycle carbon accounting analysis, which we can and have done. If you're talking about soils, you're going to need a set of tools to actually figure out where carbon is going in soils and how long it stays there. Our Advanced Research Projects agency on the energy side has invested in that. And so it's kind of identifying where each of those gaps are that we think can be really catalytic in helping to increase the integrity of that measurement, reporting, and verification while bringing down the cost of the solutions that are more mature on that measurement side is going to be really critical and where we hope to support the field.
Yes.
Hello, JJ Frejo from Brambles. We are seeing that the carbon accounting standards don't seem to be very friendly with the offsets. Science-based targets, for instance, in principle don't accept those, and net zero leave little room for that. 10%, I think, it's what we are. Do you think that will have an impact in the market, in the offsetting market?
I think science-based targets actually is quite a significant problem in terms of the narrative, because when you talk about the 10%, it's only the 10% is you can't, if that's business as usual and that's your net zero target, you can only use 10% credits to meet the abatement. It's not about being able to use credits for your net emissions footprint. And so we're finding we're doing carbon credit auctions, trying to institutionalize the primary market. And when we're talking to the buy-side community, some people are saying to us, "Oh well, I don't need to buy carbon credits. I don't need to compensate now because I'm aligned with science-based targets." And there's there's this problem of it's like science-based targets is kind of like removals markets in 2030. I'm going to buy in 2030, but I'm going to not compensate between now and then. And you're not going to create a demand signal if you're not compensating now. So I think the narrative on science-based targets needs to be sharpened up to get to more people to account for their liabilities today.
Okay. Well, unfortunately, our time has run out. I would like to thank the panels again, like Tommy, Noah, and Gordon, and I would like to invite Andrew Mitchell to the stage for the next panel on SSG. Thank you very much.